Welcome to This Week in Money. I'm Jim Goddard. Today, Don Mosher of B&D Capital in Vancouver. He discusses the fundraising challenges facing small Canadian companies. Mike Swanson from WallStreetWindow.com. He's worried the U.S. won't be able to back down on its quantitative easing strategy. We'll talk to Don Mosher right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is Don Mosher, business consultant for B&D Capital in Vancouver. Welcome to the show, Don.
Very nice to be back. Thank you.
The big issue that we're talking about is the proposed national securities regulator. BC and Ontario are on board with it. Just about every other province has reasons why they don't want to be nationally regulated. And of course, Don, your big cause has been the venture exchange, where you feel it's being strangled by over-regulation. Well, first of all, how is this going to affect the venture exchange?
Well, I don't think anybody's really sure right now, because the conflict between bureaucracies is going to be interesting to see how it irons itself out. From my standpoint and from our association's standpoint, we totally support a national securities commission. If we had a national commission, I think theoretically they could take a look at the venture issue and maybe come forward with a different set of regulations to oversee companies with market caps maybe under $100 million. I think they could reduce costs with redundancies. You know, those types of things theoretically you should support. And when they introduced the Minister of Finance for BC and Ontario along with the Federal Minister, Flaherty, that was the story that they were giving, that everybody would work in cooperation, it would cost less, and it would streamline things.
Right now, you have to go, if you're planning to invest nationally, you have to go to 10 different provincial securities commissions and 3 different commissions for the territories right now, right?
Yeah, but normally you're just dealing with the province that you're incorporated in. So that's why Vancouver downtown has so many junior companies head offices here. They're incorporated in BC, although they're trading in Toronto. The issue becomes if you're going to raise money across the country. Each jurisdiction has a different set of rules for accredited investor, for example. And if you take a look at Alberta and BC, they've got the Northwest exemption. So an individual can go out and raise money from accredited people and receive a finder's fee. In Ontario, it's a different regulation, and Quebec and the territories. I'm more familiar with BC and Ontario than anywhere else.
Do BC and Ontario kind of get along on this because they're both mining provinces?
Yeah, I think Ontario, in my mind, is not so much as a venture situation as British Columbia is. I think here not only do we have the mining, just as Calgary has the oil and gas, but we also have a very strong high-tech segment here. And as a result of having the University of British Columbia here, you see a lot of biotechs coming out of Vancouver as well. And when I talk about venture, I do not talk about mining. To me, they're completely separate issues. I would like to see venture treated as venture, regardless of what sector you're talking about.
And one of the things you mentioned about the venture exchange, right now even, they have a regulation. If you're over 65, they won't let you in because they think you're incompetent.
You know, that's a suitability clause. It's come about through a separate organization. This has nothing to do with the commissions. There's an organization called IROC, which oversees all the brokers in Canada, and they truly are national in scope. They put in it's called a client relationship model. And really, in my own opinion, my humble opinion, what they did was they took the regulations governing managed discretionary accounts, and applied those regulations to all advised accounts in Canada. And within that regulation, there is language which is up for interpretation. And what you're talking about is suitability. That would be the clause in there. So they have decided to broad brush regulations governing brokers and placing as much liability on the individual broker as possible. So the compliance departments, along with the IROC officers, have come in and said, people over 65 should not speculate. It's unsuitable for them. Now, what they don't realize is they should regulate industries and not regulate individuals. I think that's going to become our shout to regulators. Do not regulate individuals, regulate industry. Who, in their right mind, thinks that any regulator in Canada should be allowed to regulate how we invest, what financial decisions we make? They have no idea what I am as an individual at 65, and we're all aware that people appear to be aging longer, working longer. People at 65 today are not what 65-year-olds were 30 years ago. Maybe because fewer people smoke, more people exercise, we're more aware of our diet. All the factors that go into this new longer lifestyle factors into it. I brought this up with my father a week and a half ago. I was in Saskatoon, and he's never invested in anything in his life. He's an ex-RCMP officer. He's 84, and when I told him if he phoned up a stockbroker and wanted to buy a speculative stock, he wouldn't be allowed to do it, his indignation was beyond description. Basically, who the hell do these people think they are, and why has somebody not filed a class action lawsuit and taken them to court? That is an infringement of my Charter of Rights. And to me, the same thing's being applied to our younger generation. The accredited investor rule is outdated and infringes on the rights of people who should be speculating in their 20s and 30s. So that's a different issue than the National Commission issue that we're talking about here.
That rule would exclude people like Jimmy Pattison or Warren Buffett from investing, wouldn't it?
Well, if you take a look at the founders of our Venture Capital Markets Association, I'm the baby in the group, and I'm going to be 58 here shortly. I've got Joe Martin, 71. Brian Ashton's in his 70s. Larry Page is in his 70s. Tony Simon's in his 70s. All these guys are very active running their own businesses. They're in their 70s. They're not giving any thought to retiring. And here's a group out there telling them that because they've now passed the age of 65, they have no right to invest in the public markets as they see fit in their own individual circumstance.
Well, I think now they've changed the rule for commercial pilots. It used to be a hard and fast thing. At 60, 65, mandatory retirement. Those guys are in very good shape, and women, I have to say as well, up there in the cockpit. And they're saying, look at our physicals. I mean, who else has to get a physical every 6 months? If we're not in good shape, we're not going to pass, and we're going to pass up on some pretty good salaries once you become a senior captain. I think it's the same thing. They're not recognizing reality. British Columbia has the second highest life expectancy in the world, tied with Japan at 82. I think people here are marching on pretty solidly.
Joe Martin is 71 years old, and he still plays hockey every Monday night. I still do all the same things that I did when I was I do more than I did when I was in my 20s and 30s because I have more time and my family's grown up. I still play hockey. I still mountain bike. I still go on long hiking expeditions every summer. I do all of that stuff. I don't feel like I'm getting any older. I look it. But
and as long as you're active, too, your brain stays active. They've done studies on that. So in other words, these people are using a model that might have worked 30 years ago. When are they going to step into the modern times that we live in?
Yep. Well, when we're talking about different regulations here, what we have to realize is if you take a look at the accredited investor definition and the regulations overseeing that, that's the commissions. And what that has done is created a very elitist environment for the Canadian publicly traded companies because everything that they do under the accredited investor designation, unless you are a family friend and an associate, so tied to the insiders, or if you have made $200,000 for 3 consecutive years, or you have net assets less debt of $1 million or more, not counting real estate. I mean, the list goes on and on and on. But basically, everything under the accredited definition has to do with your wealth. And if you're not wealthy, you're not allowed to participate in private placements. You can buy all the stock you want off the market. But when it comes to discounted units with a warrant, that only goes to the elite. They should take a look at changing that definition and allowing people to do what they see fit with their money, especially if they're in their 20s and 30s and have not accumulated wealth yet, and allow them to create wealth for themselves by going out and actually educating themselves. And, you know, you can only regulate things so far. At the end of the day, I don't care what your investment, whether it's a house, a business, buying public stock, it still needs to be buyer beware. On all circumstances, you can only protect people so far, and they have to be aware of what they're buying and what decisions they're making and responsible for it. And you can't put all the liability on the brokers any more than you put the liability on the real estate agent or the car salesman if somebody has a fatal accident on the highway.
And I've noticed with all the regulations, somehow the bad guys find ways around it.
Do you ever see any of the big guys actually convicted?
Hardly ever. They make a deal.
And one of the other things that they're not thinking ahead to with these regulations is my analogy of what the venture market is a direct correlation to what you see with fisheries. I mean, you have a place where you go and hatch seedlings, you put them into a lake, you hope that the seedlings grow up into 6-pound trout, and people are catching 6-pound trout out of the lake with it. By seeding it all the time, you renew the population of fish in there. If you take a look at the way the venture market works, people come up with ideas for businesses. That's the seed of the idea. If the seed of the idea gets some support and they can raise a bit of additional money, at some point in time, maybe they can IPO it or do a reverse takeover on a shell on the venture board. That becomes the seedling that now starts to populate the lake. Now, some are going to get eaten, some are going to die of disease, and some are going to die as a result of bad winters. But at the end of the day, you'll get a few 6-pound trout out of them. And those trout that get caught get pulled out of the lake, but even the ones that don't get caught die eventually. Hence, we're watching the same thing happen with blackberry right now that happened with Nortel. Now, those were successful little fish that grew into the big ones that are now at the end of their life cycle, and they're going to die. And if you don't keep replacing those with what comes out of the venture market, regardless of how high the risk is there, you're going to end up with no equities, no companies, no jobs. This is all about job creation. Win, lose, or draw, you need to encourage people to speculate in order to raise that high-risk capital that ends up at the day creating those thousands of new jobs. And the U.S. is having a very difficult time of that right now. And we're starting to see it in our numbers, and everybody's scratching their head wondering why. Well, it's pretty obvious. We will not allow people to speculate.
More with Don Mosher next on This Week in Money.
Always consult your investment professional before making any investment decision.
You were just saying we're not creating new jobs, new businesses because of overregulation. A study done by Toronto Dominion Bank just released said right now the Canadian economy is barely getting along with consumer spending and the real estate market, no matter how much the government tries to pound it down. But it says without new ideas, without new sources of income, our economy is going to stall. Right there, the same thing you said just before the break.
Correct.
What can we do?
There's articles coming out right now out of the U.S. Regulations a little different, but Obamacare and the impact that trying to pass Obamacare through is having on job creation, because there's exemptions within the Obamacare that are going through, whereas if your employees work less than 30 hours a week, you don't have to pay for their health insurance. So everybody's hiring part-time people. And I think it's the same with our regulations in the securities market. It may be best intention, it may be to protect the public, but at the end of the day, none of these bureaucrats have any oversight. Nobody asks them what are these regulations going to cost and what are the impacts going to be. there is never any meaningful consultation with industry. There's consultation, but consultation means I'll sit down and listen to you, what you have to say, but I'm going to do what I'm going to do regardless. Meaningful is something that's applied to discussions now with the First Nations, where if we have a meaningful discussion and there are definite points made that see an impact to these regulations, you have to make changes. So there needs to be meaningful consultation amongst the regulators and industry as a whole.
You said every time they get together, though, it's the bureaucrats, and then maybe they bring one industry person in who's very interested in making sure the flow of money continues.
That system needs to change. I don't know how to do it. We put the association together to hopefully attract some bright minds in there and replace me with some ideas that work.
Let's take a look at the national regulatory body now. You said, well, we know Ontario and BC and the federal government are all in favor of it. How do you get the other provinces to join up?
You know, this has been a battle that's been going on for 100 years, and I don't know what the answer is going to be to it. They would have to see some net benefit to them. So I think a national regulator at the end of the day would still have a regional nature to it. You'd have, you know, the West represented on a regional basis. You'd have the territories represented regionally. Ontario and Quebec would probably be their own regions, and then the Maritimes. Now, who's going to be the boss? Is it going to be something that is on a rotating basis? For example, I believe the boss right now is out of BC, but Ontario is not going to want to go along with that for very long, nor is Quebec. They both like to be the bosses. And the net benefit to especially the territories and northern Canada needs to be addressed because they are all resource-based. And with what they're doing to the venture market right now, unemployment's only going to get worse up there. I was just in Smithers about 3 weeks ago, and I was riding back in the front seat of a helicopter, and I said to the pilot, "So are you guys busy this summer?" "Oh, really busy." "Not mining company?" "No, we haven't seen a mining company all summer. It's all environmental consultants that are renting the helicopters to study the northern pipelines, the Gateway Pipeline and the LNG pipeline. If it wasn't for that, they wouldn't have any business up there."
Nobody's looking.
Nobody can afford to rent a helicopter. Nobody can afford to do any work. Nobody can raise money, period.
And that's the big fear if they keep strangling or increasing the regulation on the venture exchange. Maybe tell us again what the whole concept of the venture exchange was and why it's so needed.
Well, the whole idea of the venture exchange is to be able to raise money for startups as a business idea continues to progress, allow you to raise more money, and when you get to a point that you can graduate to the senior board, you have less oversight on you. And the bigger players get involved. For example, although the banks own the venture exchange, I think out of the last, 400 IPOs on the venture exchange, they've participated in maybe 3 of them. So do the banks care about venture? Absolutely not. But when they graduate to the senior board, now they're looking to raise $300 or $400 million to put a mine into production. Are the banks there? Absolutely. So we need to have guys that can make money raising capital for these startups and willing to take the risk. And we need to make it attractive to the investor, as opposed to the other way around. You know, the one number that speaks for it all, 2.1% of all Canadian adults in Canada are eligible as accredited investors. And with the new CRM regulations, advised accounts over 65, which are part of that 2.1%, will be taken off the table. What's that going to leave? A few 100,000 people in all of Canada that can speculate? And you're trying to tell me that it doesn't impact the venture market? So now we are seeing crowdfunding, and we're seeing all these other ideas. Well, there you go. What good are the regulators? The regulators are forcing people to seek alternative routes for raising capital that don't involve the regulators.
So you go from over-regulation to no regulation.
Yeah, and then you want to see fraud? Just wait for that to hit the street. So you've put the independent brokers out of business. They were basically your first line of defense against fraudulent deals. Their compliance forces the brokers to really take a hard look at things because of the liability attached to it. You've got IROC overseeing the compliance departments, and you got the commissions overseeing the overall business community. And now you're going to force people into the crowdfunding market. That's no different than some guy going out and saying to his in-laws that he wants to open a bakery and gets $5,000 from each of them, and then they find out not only does he not know how to run a business, but he's never baked a loaf of bread in his life.
And we're seeing that kind of misdirection then of this funding.
Yep, we are. I mean, right now, people don't know where to go or what to do. When they put the accredited investor regulations in, people started to head to foreign jurisdictions more and more, looking for investors that could qualify as accredited because they were offshore. So going to the UK, going to Switzerland, now people are going to Asia. That basically shut down the retail market in Canada. Now, if I'm a foreign investor, I don't want to own Canadian securities. If they won't allow my own citizens to invest, why would I want to participate in a Canadian venture? They can put all the regulations they want in place, talking about transparency, talking about accounting, auditing, reporting, and all the rest of it. Bottom line is people go into the public markets for the liquidity that it offers. You can buy and sell things. You don't want to just be able to buy things and get buried in them for the rest of your life. The volumes have dried up and disappeared. The retail investor, which always offered all kinds of distribution to everyone, is completely out of the marketplace. He's not allowed to participate anymore. So you get some funds. Well, when a fund gets redemption, look out below. There is no question what they're going to do, regardless of who's buying it at what price. They're selling it. They are filling every bid within sight. When we have public participation, that was not so much the case. You've got thousands of people owning small share positions, disagreeing with each other. Some think it's a buy, some think it's a sell. Someone's going to win, someone's going to lose. It's just the nature of the beast. You can't circumvent that.
Don, is there a website that people could go to if they want to learn more about the crisis as you feel it is with the venture exchange?
Well, we have a website, venturecanada.org is our website, and we do post articles on there. We post interviews. This interview will end up being posted on there. Anything that we see applicable to the venture market, we put on there. We're looking to raise money to fight this battle. So if somebody wants to come in and give us $5 and put their name down as a sponsor, we'll welcome them with open arms. We need numbers because we need to talk to politicians. Politicians do care about job creation, and that's the battle that we're fighting.
Thanks a lot for chatting with us, Don.
Always a pleasure. Thank you very much.
After the break, Mike Swanson on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Yeah, thanks for having me.
I understand one of your big fears is that the U.S. government's policy of quantitative easing, or the Federal Reserve, which might as well be the same thing because they're not going to do anything the government doesn't want. You're scared that they're going to continue this $85 billion printing of money every month for how long? Forever?
Well, I believe so. And the reason why, first of all, I was really surprised last week when they didn't reduce the quantitative easing program, by 5 or 10 billion. They had put in, Bernanke and other Fed officials had spoken for weeks that they had intended to do just that, and then they didn't do it. And what is interesting is that, since then, if you watch CNBC or read about this stuff, most of the commentary is to the effect that, well, the economy didn't grow as fast as they thought it would, and they're watching economic numbers, and so if it grows, then they may reduce it, and so forth, so they're going to be watching it. Well, in reality, I think the situation is much more alarming, because in the very first paragraph of the FOMC statement last week, the very final sentence of it, says that they didn't want to reduce it because interest rates went up because bonds fell in price a little bit. And they're afraid of what they called fiscal issues with the United States government, meaning the size of the budget deficit. In other words, they don't want to see interest rates go up, and I believe this is going to prevent them from reducing the quantitative easing program. And in fact, I wouldn't be surprised if next year or the year after, at some point, they will be increasing it instead of decreasing it. And that's something no one in the media is talking about, and I think will, provide a huge fuel to the gold market when it happens.
I understand the most likely new chair for the Fed is very much in favor of quantitative easing, and she is the one talking about making it perhaps $100 billion a month.
Yeah, that's exactly right. And what I'd like people to do is to investigate something on their own, because I'm going to say something that people they'll probably have trouble believing this, but so they need to see this for themselves. But I post on my website a link to a Federal Reserve, an internal Federal Reserve study, and I'm actually writing about it this weekend for my newsletter. But the title of it is Crunch Time. The author is a man named Fred Mishkin. So if the people can go to Google and type Fred Mishkin and then Crunch Time, they should be able to find this. Now, what it says is that, one of the things it says is that if interest rates for the 10-year bond were to go beyond 5.2%, the cost of financing the debt for the United States government would become so expensive that it would essentially default. What this means is that the Fed can't allow the interest rates to go that high. So they'll have to increase quantitative easing at some point in the future if bonds, were to continue to decline like they have over the past couple of months. And it's a pretty shocking report. And it's amazed me that I haven't found anyone in the media and the financial news that have talked about it or investigated. And to give you an idea of how earth-shattering this report is, in 2007, the same gentleman, back then he was a governor on the Federal Reserve Board, and he's a close friend of Ben Bernanke. Well, he wrote a report then, August of 2007, that said, what would happen if real estate prices in the United States declined? And he said, well, here are the economic projections. The whole economy would basically collapse for years. And the Fed should, if this starts to happen, rapidly lower interest rates to zero. Well, that's exactly what happened and took place. And it was all laid out in this report written in August of 2007. So here we go. Here's another report commissioned by the same person that was presented at a Federal Reserve Board conference in Chicago in February, revised in the summer, presented again in the August Jackson Hole roundtable get-together the Federal Reserve puts on every year. So this is a big topic of discussion, and it's all laid out for anyone to want to go read. So it's not like some, you hear people say alarmist things all over the internet or sometimes even on radio or whatever. But here's something, this is me saying this, or one of the regular suspects in the gold market, that this is an internal study by the Federal Reserve.
And that's something that you really should pay attention to, because every time they burp, it seems, the market goes nuts.
Yeah, that's right. And I'd like to also refer people to another Fed governor, a member of the Fed, Fred Bullard, who wrote a report, I think it was in 2010, but it was before the quantitative easing program began, and the report just, laid out the rationale for it, explained it, and then, a month or two later they began it. So I think part of what is going on with this current report is it places the blame for any potential crisis on the U.S. Congress for not controlling government spending or doing anything about the budget deficit in the United States. So it's sort of a political cover for Ben Bernanke and the other Fed officials if the crap hits the fan. And I think what is likely to happen, you mentioned Janet Yellen coming in next year. It apparently looks like she's going to be the one. Well, my assumption is I think logic would say that the Fed probably won't want to do anything till she gets in there. Bernanke won't really want to make any more changes because he doesn't want to make waves or do anything dramatic, so soon when she's just about to get in. And then when she gets in, I don't think she's going to really want to do anything either. Really, the Fed's trapped, and all they have left really is the hope that the economy does recover and there's a giant boom that just somehow fixes things, and she's just not going to want to do anything. But if the stock market has a correction next year, the bonds drop again like they have the past few months, then I think she will hit the button and increase quantitative easing. And if that happens, the things I'm been talking about, they're not on the television. There aren't any reporters even talking about this report. And it's just the small gold bug community that really is alarmed of the potential disaster that's to come. But if she hits the button and increases quantitative easing, people will start to ask questions. And I think you'll see a lot of people who have never before considered buying gold start to do it.
And you're saying they hope the economy improves. An expert in risk management told me hope is not a plan.
Well, when this paper was presented at this Fed seminar in February, I don't remember the guy's name, but someone wrote a dissenting paper saying why this won't happen. And his argument was that the U.S. debt to GDP right now, it's 78%. And the paper shows you how levels above 80, become problems. Levels above 100 lead to crises. So if the bonds yields go to 5.2%, the U.S. government can quickly shoot up past the 100 mark. Well, the dissenting opinion is that, that happened during World War II. The U.S. debt to GDP was above 100% towards the end of World War II, and there's no crisis, there's no turmoil in the financial markets, the American economy, or anything like that. So they say, well, everything was fine then, it can be fine again. However, what they fail to recognize, and I think it's completely unrealistic to expect what happened then to happen now, because the whole world was devastated for World War II. The United States was pretty much, in Canada too, I suppose. Canada wasn't devastated, of course, but North America was the only continent that wasn't really destroyed by the war. So we had all our factories, and we were exporting to the whole world and helping them rebuild. And, of course, we had the highway system was built, houses built across the country for the baby boom, or the incoming veterans and the baby boom kids that were
and
born
cheap
then.
land in the suburbs.
Yeah, the suburbs didn't even exist until after World War. All this stuff was built. So that's just not, ain't going to happen. We're not going to have a boom like that in the next couple of years. So I don't think there is a solution. I think this is it, the end game for. And I don't think it's something to be scared about. It's not the end of the world. You just have to know and understand could happen and the reasons why, and just be prepared. It's no big deal if you do that.
It may not be the end of the world, but you can see it from there. On your website, Mike, I noticed you have a couple of interesting articles, one listed as the most dangerous stock markets in the world and the best stock markets. So first of all, where are dangerous places to put your money?
Yeah, glad you asked that. And despite what I was saying the last segment about, I wasn't speaking about the United States there, because I do think we're still in a bull market. I don't see any signs that that's over yet. However, if you look at all the world markets and look at them by valuation metrics, especially the cyclically adjusted P ratio, which takes the 10-year average of the P ratio adjusted to inflation. It's the Robert Shiller indicator. Well, if you do that, the U.S. stock market is overvalued. It's got a cyclically adjusted P of 24, when somewhere like 13 to 15 is historically the median of the range. Well, the most overvalued market, though, is the Indonesia stock market. And it fell about 30% just the other month, and now it's bounced back up. But on charts, which I like to use technical analysis and charts along with fundamental stuff, well, if you use the chart, there's an ETF, IDX. It's made a top over 2 years, and it broke down below support, the 2-year low the past couple years. The 2-year low broke it in the summer, fell 30%. It's below the 150 and 200-day moving averages, and it's just bouncing back up. So the chart's very bearish. It looks like it's starting a bear market. It's having its first, little bear market rally that'll end with lower prices, and it's the most overvalued market in the world. And so that's what I would say is the most dangerous one. Now, the ones that had the most potential, though, are the European markets as a whole, because they are the opposite situation. They have the cheapest valuations when it comes to the cyclically adjusted PE. The Russian market's around 8. Italy, Spain, Belgium, and Austria are all below the 9 level. In Greece and Ireland are like 3 at a level of 3 and 4, which there's only been a few instances in history where a whole country and its market get that cheap. So you got markets at really low valuations, and now they're also in early bull markets. Whereas the U.S. stock market's been going up since 2009, these markets had a bear market in 2011 and 2012, and they're just in the beginning of a new one. So you got a lot of upside on the charts from that standpoint, and they also had super cheap low valuations. And if you're a listener also interested in the commodity market, then Russia is one of these that you should consider taking a look at, because it's linked to the commodities, and it's, like I was saying, cheap and starting a bull market, and there are some individual stocks there too. I own, for example, Gazprom, OGCPY is a symbol for that, and it's paying like a 4% dividend with a P of 3, and is one of the largest natural gas producers in the world. And that's a super cheap valuation, but you can find stocks like that in Europe and in Russia and Ireland because, they had such a bad bear market last year.
And Russia, of course, is talking about building a natural gas pipeline to China, which could shoot down BC's proposed idea of shipping liquefied natural gas there.
Oh, really? I didn't know that.
Oh, yeah. It's a big part of BC's financial plan.
Well, I guess it's good if you're investing in Russia.
Well, also in Japan, they had high inflation numbers last month, and all of the inflation was caused by high energy prices as their atomic power plants go offline and need to be replaced with something else. And right now, they're not really keen on anything that has the word nuke in it.
Okay.
So there's some hope for liquefied natural gas after all, I guess.
Sure. Well, one thing about investing in these type of markets too, especially for someone like me living in the United States, it's also a way to escape from being completely tied to the dollar in the United States stock market or traditional American investments. So if I can invest in Europe and in these other opportunities outside the United States, if there's financial problems with the debt in the United States in a couple of years, well, that'll help be somewhat of protection from that, along with investing in gold. So I think people can really be diversified. You don't even have to worry about some big crisis or anything like that, and you can still be in markets that are in a position to do well in the next couple of years, regardless of what happens.
If you're telling somebody today, putting together a portfolio, a big international basket of goods, don't just put everything into one area or one country or one stock market.
Yeah, exactly. And actually, another thing too that I own a lot of stocks in this sector, but it really looks really good, and that's the shipping stock sector. And they also crashed. Same thing happened. They bottomed last year, got super cheap. A lot of them paid good dividends, but now they're breaking out. They've done really well this past month. And what's noteworthy about that is the Baltic Dry Index, which tracks the shipping rates that shipping companies charge for transporting bulk goods across the ocean. Those shipping rates have broken out, and they were up 5% just 2 days ago. So they're up. In fact, they're up 3 times what they were in February. So the shipping rates are really taking off. And what's real important about that, though, for most of your listeners, is that the Baltic Dry Index, it tends to lead the action in commodities and gold. So that's actually a real bullish signal for, if we just go by the Baltic Dry Index as one indicator, we should expect to see, gold and commodities as a whole break out too sometime soon and begin a big march higher.
I know too, with the liquefied natural gas proposals here in BC, when it first came out, I asked, do we have enough of those giant ships that looks like they're carrying giant golf balls on their deck to carry this gas? Well, at the time, no, but they're building them, and they're building safer ones, apparently.
Oh, that's good. That's good.
Of course, that isn't a dry good, but again, shipping, apparently, as you said, optimistic with growth in that area. And I guess people, too, there used to be a time you could buy individual shipping containers. Is that still a hot business?
Yeah, I think it is.
So, own your own container. Do you get to put your own name on it?
Well, you can go to Walmart or wherever and buy a spray paint can and do it that way.
Well, as we're wrapping up the month, September traditionally has been horrible for the North American markets. Yeah. Do you think we're going to get out of this September alive?
Well, we don't have but one more day. So, actually, we are in a bit of a correction, though, and for the S&P 500, it's down about 2% from where it was the day the Fed didn't reduce its quantitative easing. We rallied into that announcement and have been falling since then. But I don't think there's a huge amount of downside left because today, as we're speaking, the VIX is up 10%, which measures a fear premium in the options market. So, these corrections, when they happen, usually end when there's, fear and panic, and, a 10% move in that doesn't necessarily mean it's the bottom, but you can't have so many more days like that. So, I think we'll probably bottom in a week or two and probably do well for the rest of the year. I do think these other world markets, though, will lead and, where the S&P could go up 5%, these things will probably go up 3 times as much.
Mike, thanks a lot for chatting with us, and maybe again remind our listeners about your website.
Sure, thanks for letting me do that. It's wallstreetwindow.com, and people can sign up, and there's a free email list where you can get updates from me when I buy or sell something on it too.
Thanks to our guests, Don Mosher and Mike Swanson, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.